Bear markets can feel scary, confusing, and expensive, but they can also create some of the best long-term opportunities investors ever get. The problem is, most people do the exact wrong thing at the exact wrong time. They panic, they sell low, they chase safe ideas that are not actually safe. And then, when the market recovers, they are sitting on the sidelines wondering what happened. In this video, we are going to talk about smart ETF strategies for a bear market. Not hype, not predictions, not this one secret fund will save you. Just practical strategies that can help investors stay calm, diversified, and focused. Welcome to Simply Speaking About Money. This channel helps beginners understand budgeting, saving, investing, and building wealth using probabilities instead of possibilities. Educational only, not financial advice. First, let's be clear. A bear market usually means the stock market has fallen 20% or more from a recent high. That does not mean the world is ending. It means prices are down sharply. And when prices are down sharply, investors have two choices: panic because prices are lower, or prepare because long-term opportunities may be better. The first strategy is simple. Do not try to predict the bottom. Trying to perfectly time a bear market is like trying to catch a falling knife while blindfolded. Exciting? Maybe. Smart? Usually not. Instead, many long-term investors use dollar-cost averaging. That means investing a fixed amount regularly, whether the market is up, down, or having a dramatic emotional breakdown. A broad US stock market ETF can be one option for long-term investors. Examples include VTI, Vanguard Total Stock Market ETF, or SCHB, Schwab US Broad Market ETF. These funds give exposure to hundreds or thousands of US companies. The goal is not to guess which company survives the bear market. The goal is to own a broad slice of the market and let time do the heavy lifting. That is boring. Boring is often useful. Another option is an S&P 500 ETF. Examples include VOO, IVV, or SPY. These track large US companies and are commonly used by long-term investors. Now, does that mean the S&P 500 cannot fall more? Absolutely not. It can fall. It can stay down longer than expected. It can test your patience like a toddler in a grocery store. But for long-term investors, broad index ETFs can help reduce the risk of betting everything on one company, one sector, or one hot idea. That matters in a bear market. The second strategy is adding bonds carefully. Bond ETFs can help reduce portfolio volatility depending on interest rates, duration, and the type of bonds owned. One example is BND, Vanguard Total Bond Market ETF. BND gives broad exposure to US investment-grade bonds. As of Vanguard's current fund data, BND has a low expense ratio of 0.03%. Another more conservative bond option is short-term Treasury exposure. An example is SHWI, the iShares 1 to 3 year Treasury Bond ETF. Short-term Treasury funds usually have less interest rate sensitivity than longer-term bond funds. SHWI currently lists an expense ratio of 0.15%, according to iShares fund data. This type of fund may appeal to investors who want stability more than maximum return. But remember this: bond ETFs are not magic shields. They can still lose value, especially when interest rates move quickly. So do not assume bond automatically means no risk. The third strategy is using dividend-focused ETFs carefully. Dividend ETFs may appeal to investors who want companies with a history of paying income. One example is VYM, Vanguard High Dividend Yield ETF. VYM focuses on higher dividend-paying U.S. companies. Vanguard currently lists VYM's expense ratio at 0.04%. Dividend ETFs can feel comforting during bear markets because investors may still receive dividend payments, but dividends are not guaranteed. Companies can reduce them. Companies can eliminate them. And yes, that is rude. Dividend ETFs should not be treated like guaranteed income machines. They are still stock funds. If the market falls, dividend ETFs can fall too. The fourth strategy is defensive sectors. Some investors look at sectors like consumer staples, utilities, and healthcare during bear markets. Why? Because people still buy food, use electricity, and need medicine when the economy slows. Examples include VDC for consumer staples, VPU for utilities, and XLV for healthcare. These are sector ETFs. They can help tilt a portfolio toward more defensive areas. But be careful. Sector ETFs are narrower than total market ETFs. That means they can help in some periods and disappoint in others. Defensive does not mean invincible. The fifth strategy is keeping cash available. Cash is not exciting. Cash will not impress anyone at a party, but in a bear market, cash gives you flexibility. Cash can help you avoid selling investments at a bad time. Cash can help cover emergencies. Cash can also allow you to keep investing when prices are lower. That is why an emergency fund matters before aggressive investing. If every market drop forces you to sell, your portfolio is probably too risky for your real life. The sixth strategy is rebalancing. Rebalancing means bringing your portfolio back to your target mix. For example, maybe your plan is 70% stocks and 30% bonds. If stocks fall hard, your portfolio might become 60% stocks and 40% bonds. Rebalancing may mean buying more stocks when they are cheaper. That sounds simple. Emotionally, it is not. Bear markets make good strategies feel uncomfortable. That is the whole point. If investing felt easy during market crashes, everyone would do it well. They do not. The seventh strategy is avoiding panic moves. Do not sell everything just because headlines are scary. Do not move everything into cash because someone online says a crash is coming. Someone online always says a crash is coming. Eventually, they look right. That does not mean they had a plan. The eighth strategy is avoiding bear market hero investments. These are the things people chase because they think they found the perfect protection. Leveraged ETFs, inverse ETFs, complex trading products, hot recession stocks. These may sound smart, but many are designed for short-term trading, not long-term investing. For beginners, they can be dangerous, especially if you do not fully understand how they work. A simple bear market ETF approach could look like this: a broad stock ETF, a bond ETF, possibly a dividend ETF, possibly a defensive sector ETF, and cash for emergencies. That does not mean everyone needs all of them. A younger investor may focus more on broad stock ETFs. A retiree may care more about stability, income, and cash flow. Your strategy should match your time horizon. Here is one example of a simple long-term structure: core holding, VTI or VOO, stability holding, BND or SHY, optional income tilt, VYM, optional defensive tilt, VDC, VPU, or XLV. Again, this is not a recommendation to buy these funds. It is an educational example of how investors might think about categories. Your own situation matters. Your risk tolerance matters. Your time horizon matters. The biggest mistake during a bear market is not simply losing money on paper. The biggest mistake is breaking your plan because fear took over. Bear markets punish investors who need certainty. Markets do not offer certainty. They offer risk, reward, volatility, and opportunity. That is the deal. So before buying any ETF, ask 3 questions. What role does this fund play? How long can I hold it? Will I still be comfortable owning it if it drops? If you cannot answer those questions, slow down. The best bear market strategy is not the one that sounds smartest. It is the one you can actually stick with. Bonus tip: create your bear market plan before the next big drop. Decide your investment amount. Decide your ETF categories. Decide your rebalancing rule. Do it before panic shows up, wearing a breaking news costume. Bear markets are uncomfortable, but they are normal. They have happened before. They will happen again. The investor who survives is usually not the loudest. It is the investor with a plan. Thanks for watching Simply Speaking About Money. If this video helped you, subscribe for more beginner-friendly videos about budgeting, saving, investing, and building wealth the calm way. Remember, build your money using probabilities, not possibilities. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning, so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.